Yeah, I know. Thank you. So, welcome back, everybody. My name is Octavion, and today we're talking about options. Everybody got options, right? But we're talking about options in terms of stocks, right? So, and whether they're a scam and whether they're beneficial for you as far as an investment standpoint, whether you should get into it, all that good stuff. So, before we get into the video, make sure to like, comment, and subscribe to the channel if you like this kind of content. I post every Thursday now. So, yeah, I post all kinds of stuff. So, yeah, make sure to check out the other videos. Make sure to share. Make sure to like, comment, subscribe, all that good jazz. And let's get into the video. Okay, so what is an option? An option is a contract basically between two entities, whether it be you and somebody else or you and a firm, whatever. And it's basically an agreement that you or them are have the option to buy a certain stock, right? So it's like this contract basically saying that you have the option to buy or sell a certain stock. So as an example, let's say you see a stock that is super interesting to you and you want to buy it, but you don't have the capital to actually purchase the stock. So let's say the stock is worth $1 and you want to buy 100 of that dollar stock, but you don't have the money for it. So you put $5 into an option to buy the stock for $1 at that set price, right? So you're $5 in the hole, right? And let's say that dollar stock shoots up. So now the dollar stock is worth $100. You can capitalize on your investment of $5, right? And invest the other $95. So you put in your total $100 for that dollar stock. So you're purchasing that. It's kind of confusing now. I'm explaining it. That dollar stock that just went up to $100, you purchased it now with your $100. So now you have 100 of those stocks. So now you just got 100 times 100. You just got $10,000 minus your $5 minus your $100 investment. So then now that is a profit of $9,895. Does that make sense? I hope that makes sense. Basically, you just made a whole bunch of profit because that stock shot up and you had the option to buy it at a cheaper price, right? So, and that's why a lot of people buy options, because options allow you to make big instrumental changes in your and have larger profit margins than regular just like trading stocks and bonds. So it's very interesting in that facet, but it's also more risky too, because you could also flip the scenario. You buy that stock for you buy the option, or sorry, when you this is the same thing. Like it's limited risk in this specific option, because if that stock says crashes and you're and it goes from $1 to zero, right? It goes bankrupt. You don't have to capitalize on your option to buy it. So the only thing you lost was your initial $5 investment. So it's like it is a downside, but it's not as bad of a downside. But the upside is a lot bigger if you see that. So, but then there is multiple types of options that you can do, right? So we'll go into them. So first is buying a call. A call is the example where I just said, where you would basically have the option to buy a particular stock for a particular price, and the call it can range in like the time limit, but it's usually about a month. You'll say that you have the option to purchase that stock in that month span for that certain price before it expires. So you have the option to buy a call. Then you have the option to sell a call, which is basically you own the stock and you are selling an option for that stock, right? So let's say I own 100 shares of Tesla. I could sell the option to buy Tesla, my 100 shares of Tesla, to someone, and they can and they'll have the option to purchase it depending on their whatever they want to do with that stock, right? And then you have a put, right? So you can choose to buy a put. Basically, if you own or you don't own the stock, you're basically buying the right to sell someone else's stock. So it can be a stock you own or a stock you don't own, but you're buying the right to sell that stock, basically. And then selling a put is basically you are selling your right to sell that stock. So you're selling to someone else the option to sell your stock. So if I own 100 shares of Tesla again, I can sell my right to sell that option on that particular stock, so that someone else can profit off that off the fluctuation of that option, if that makes sense, right? So those are the four, basically. So I know that's a little confusing, but I hope throughout this video it can make more sense. So 4 options: buying a call, selling a call, buying a put, selling a put. Those are the 4. So now we can talk about the risk associated with the each individual option, right? So for buying a call, right? For buying a call, which is the scenario where you can buy the option to purchase a stock for a set price, your earning potential, the upside of it is unlimited, because that stock could shoot up in price by so much, and then you can buy it at that original listed price that you bought the option for, and then sell the rest of it and get your profit. Or the downside of it is just the initial premium, which is the amount of money that you spent on the option. So in the original scenario where I explained before, that would be the $5 I spent to buy that particular option, to buy the Tesla stock for $1. So so that is the risk of buying a call. The risk for and I meant to mention, for that scenario, for the risk, that those people are called call holders. Then you have call writers, right? This is when you choose to sell your call. So or you sell your stock that you own. So you sell an option on your stock that you own. So for this one, the earning potential is it's only the premium. It's just a flip, basically. So the earning potential is the premium that they pay you for it. So the initial investment they pay you, and then the downside is unlimited for that, because the stock could end up you can end up being and you can end up selling the option. The stock could shoot up, and then by a whole bunch of money, and then you end up losing out on all that money because you had them, and then that person chose to cash in on the option, so you end up selling that stock for way below market value in that case, which sucks, but that's what comes with the option. But at least you got something for it, because you got that premium. So it's just kind of depends on the scenario, but that is part of the risk, right? Next is the put holder. So this is the person that buys the option to sell a certain stock, right? So the upside for them, the upside for them is the difference between the prices of the price, or the difference between the prices of the stock from when they bought the option to sell it. So if they have a strike price, which is the price that the person who they bought it from, who they bought the option from, will have to sell it at. So the difference between those prices versus where it's currently at, the difference between those prices is the earning potential of what that person that bought the put has. And then the downside is just the premium, the amount of money that they spent to buy that specific option. So for them, they will want the money or they would want the specific stock price to go down, so then they could end up they can end up selling the put for a higher price. Basically, they can sell the option for a higher price, or the stock for a higher price. I'm sorry. So, and then you have the put writer, which is basically the person that is selling the option to buy a certain stock. So if I own Tesla, we'll keep going with Tesla. If I own Tesla and I'm selling to someone, hey, you can buy, and the Tesla's worth like $100 right now. If I can sell the option to someone to force me to sell the stock at if Tesla reaches I don't know $80 or something like that, and so for me, I would want the price to stay the same or go up. So then I would never have to sell the stock, and I could just keep the profits, and I already got the premium from them. So like the upside is the premium that I got. The downside can be the difference in the share prices and the stock prices. But I don't want it to hit the strike price, the price that they want. The buyer, I don't want it to hit them because then I'll have to sell it for whatever price he had it set at. So I hope that made sense. It's a very confusing concept of options, but as you can see, the earning potentials of the options are a lot higher than the general stock market of stocks and bonds, but it comes with a lot of risk. So you have to do a lot of research on the different kinds of stocks or the different kinds of options that you can buy, and then the options that you think may be of best interest for you. You may be somebody that mainly focuses on calls and don't really focus on puts, or vice versa. Um, or you could just buy all kinds of options. But the thing about options is it's basically just hedging your bets. So it's just like saying that, okay, I think that this will happen, or I feel like this company is really good and it's gonna go up, or this company is not really that good and I'm questioning what's going to go down. That's what the options are for, because you can take risk and limit your risk, but then you can also take risk and for a heavy gamble with the big risk, but then it's also a big payout. So it just depends. But the question being answered is options risky? Very. If you do your research, it's just about as risky as any other stock investment. Um, like investing like in a general like individual stock, it's just as risky if you do your research. But if you go in blind and just do it, then yes, it can be very risky and you can lose a lot of money, or you could gain a lot of money too. Like there's been random success stories, but a lot of banks, hedge funds, all of them have options as well. They invest in options, so it's a very common and not a scammy thing. It's just how you play it and making sure that you understand the game and how you can make the profit. So that is the video. I hope it was beneficial, and I hope I made things kind of clear. Let me know in the comments down below if it wasn't clear for you, because I want it to be as clear as possible, so I can try to explain it a little bit more in the comments, or I can possibly like link in the description like a video, another video that may like illustrate it, so then it's simpler to understand as well. But yeah, so yeah, thank you all for watching. I recommend hitting the like button. I highly recommend it. Recommend subscribing as well. That's a great thing to do. And commenting is always fantastic. Sharing is great. All those things, do all of them. Appreciate it. Yeah, but I'll catch y'all later. Yeah, peace.